problem is the inputs to those formulas, they change, right? And that's a big part of the recent, kind of reassessment here in the bond markets, really all the financial markets, that the data has been revised, and the data, particularly on labor markets, the data in terms of the consumer and the broad economy, the debate between GDP and GDI basically was settled in favor of GDP being the right measure, meaning this economy is as strong as it appears and not this kind of sneaky weakening. And so the data going into those formulas is changing, and it's basically saying, the Fed is not as restrictive as it thought it was.
And so in that case, on the back of this latest jobs report and ahead of the CPI data later this week, what is speculative trading in the futures market for bonds telling us about the direction of yields?
Well, you don't have to look at the futures markets to see what the trading is saying. It's basically spoken pretty clearly here, and I think you highlighted it in the break a minute ago, that we priced out the expectation that we were going to have 350 basis point cuts in a row, and now you've backed off that pricing to November's 25. It's actually a little bit underneath the 25, and then another 25 in December. And so you're back to a little bit more of the bond markets aligned to what the Fed was saying, whereas before, and really much of the year, the bond market has been just very much aggressive, kind of overreacting. Obviously we came into the year, huge expectations for a lot of cuts. We had to price that out given the inflation level. And then,
as we head into the final months of the year, how are you suggesting to clients, what do they buy, what do they sell in the Treasury market?
We've been, pretty adamant that the vulnerability in the bond positioning for most clients is what we've been seeing a lot in the flows. And what you see in the flows is this kind of knee-jerk reaction to the expectation of the commencement of the Fed's cutting cycle. And the knee-jerk reaction is, if the Fed's cutting interest rates, then duration is my friend, and I want to own the maximal amount of duration in my portfolio. I want to own the longest maturities out there. And that we've really been very much saying, you got to be careful. Number one, it's a little bit of buy the rumor, sell the news. The Fed cut 50 basis points and bonds lost money. So a lot of it was already in the price, and you had a lot of heightened expectations. And number two is that you just have a differential reaction along the maturity spectrum when the Fed cuts rates. It's mostly in the front end where you see that impact. And the back end can be affected by a lot of different things besides just the Fed cutting.